In this video, we take a closer look at dYdX, a decentralized exchange built on the Ethereum blockchain. With the use of smart contracts, dYdX provides a secure and trustless platform for trading various cryptocurrencies. We'll dive into how the platform works, its benefits over traditional centralized exchanges, and the potential impact it could have on the world of finance. If you're interested in learning more about dYdX and the power of decentralized exchanges, be sure to watch the full video and leave your thoughts and questions in the comments below. Don't forget to subscribe to our channel for more informative videos on blockchain technology, and hit the notification bell to stay updated on our latest content. Thanks for watching. dYdX, a decentralized exchange built on the Ethereum blockchain that allows users to trade cryptocurrencies, including derivatives such as futures and options. It was founded in 2017 and is based in San Francisco, California. The main goal of dYdX is to provide a decentralized trading platform that is secure, transparent, and accessible to anyone. By using smart contracts, dYdX eliminates the need for intermediaries and allows users to retain control of their assets at all times. The platform also offers margin trading, which allows users to borrow funds to increase their trading power. However, margin trading can be risky, and users should be aware of the potential for losses. Overall, dYdX is a promising project in the decentralized finance (DeFi) space, and its innovative approach to trading and derivatives has attracted a lot of attention from investors and traders. Sure, I'd be happy to provide more information about dYdX. dYdX is built on the Ethereum blockchain, which allows for secure and transparent transactions through the use of smart contracts. These contracts are self-executing and enforceable agreements that automatically execute when certain conditions are met. One of the key features of dYdX is its ability to support margin trading, which allows users to borrow funds to increase their trading power. This can lead to higher profits, but it also carries a higher risk of losses. dYdX has implemented various risk management tools to help mitigate the risks of margin trading, such as margin calls and liquidation mechanisms. Another notable feature of dYdX is its support for trading of derivatives such as futures and options. These financial instruments allow users to speculate on the future price movements of cryptocurrencies, and can be used for hedging purposes as well. dYdX has a native token called dYdX, which is used to govern the platform and incentivize users to participate in various activities such as liquidity provision. dYdX is an ERC20 token, which means it's built on the Ethereum blockchain and can be stored in any wallet that supports ERC20 tokens. Overall, dYdX is a promising project in the decentralized finance space, and its innovative approach to trading and derivatives has attracted a lot of attention from investors and traders. dYdX is one of many decentralized exchanges, DEXs, that have emerged in recent years to offer an alternative to centralized exchanges. Here are some ways that dYdX compares to other DEXs. 1. Trading features. dYdX offers a range of trading features that are not available on many other DEXs, such as margin trading, which allows users to trade with leverage, and the ability to trade options and futures contracts. 2. Security. dYdX is built on the Ethereum blockchain, which is known for its security and transparency. The use of smart contracts also helps to ensure that transactions are executed in a trustless and decentralized manner. 3. Liquidity. dYdX has worked to improve its liquidity and has attracted a growing number of users, which helps to ensure that there are enough buyers and sellers to execute trades. 4. Fees. dYdX has relatively low fees compared to many centralized exchanges, and these fees are used to incentivize users to provide liquidity to the platform. 5. User interface. dYdX has a user-friendly interface that is easy to navigate, which makes it accessible to a wide range of users. However, some users may find the platform's trading interface to be more complex compared to other DEXs. Overall, dYdX offers a unique set of features and benefits that set it apart from other decentralized exchanges. Its focus on margin trading and derivatives make it particularly attractive to professional traders and investors who are looking for more advanced trading options. Sure, I'd be happy to explain how margin trading works on dYdX. Margin trading allows users to increase their buying and selling power by borrowing funds from the platform. When a user borrows funds, they are essentially taking out a loan that they can use to trade with. To initiate a margin trade on dYdX, a user must first deposit collateral into their account. This collateral can be in the form of cryptocurrencies such as ETH or DAI. The amount of collateral required will depend on the size of the trade and the leverage that the user chooses. Once the collateral is deposited, the user can then borrow funds from the platform to increase their trading power. The amount that can be borrowed will depend on the user's available collateral and the leverage that they choose. It's important to note that margin trading comes with a higher risk of loss, as losses can exceed the amount of collateral that was deposited. dYdX has implemented various risk management tools to help mitigate the risks of margin trading. For example, if a user's account value falls below a certain threshold, a margin call will be triggered and the user will have the opportunity to add more collateral to their account. If the margin call is not met, the user's position will be liquidated to repay the lender. Overall, margin trading on dYdX can be a powerful tool for experienced traders and investors who are looking to increase their trading power. However, it's important to understand the risks involved and to use caution when trading on margin. Margin trading on dYdX, like any other trading platform, involves certain risks that users should be aware of. Here are some of the main risks associated with margin trading on dYdX. 1. High leverage. Margin trading allows users to trade with leverage, which means that they can control a larger position with a smaller amount of capital. However, this also means that losses can be magnified if the trade goes against the user. 2. Liquidation risk. If the value of the collateral drops below a certain threshold, a margin call will be triggered and the user will have the opportunity to add more collateral to their account. If the margin call is not met, the user's position will be liquidated to repay the lender. This can result in a complete loss of the user's capital. 3. Volatility. The cryptocurrency market is highly volatile, which means that prices can fluctuate rapidly and unpredictably. This can increase the risk of loss, especially for users who are trading on margin. 4. Technical issues. Like any other trading platform, dYdX is subject to technical issues and downtime. If the platform experiences significant technical issues or downtime, users may be unable to execute trades or manage their positions. 5. Regulatory risk. The regulatory environment for cryptocurrencies and decentralized exchanges is still evolving, and there is a risk that regulations could change in a way that negatively impacts dYdX or its users. It's important for users to understand these risks and to use caution when trading on margin. It's also a good idea to start with a small amount of capital and to gradually increase the size of trades as experience and knowledge of the platform grow. dYdX charges fees for margin trading, which are used to incentivize users to provide liquidity to the platform. Here are some of the fees associated with margin trading on dYdX. 1. Trading fees. dYdX charges a trading fee for each trade that is executed on the platform. The trading fee is based on a percentage of the total value of the trade and varies depending on the asset being traded. 2. Borrowing fees. When a user borrows funds to trade on margin, they are charged a borrowing fee. This fee is based on the size and duration of the loan and is charged as a percentage of the borrowed amount. 3. Funding fees. dYdX also charges funding fees for margin trades that are kept open overnight. Funding fees are based on the difference between the interest rates of the two currencies being traded and are charged to the user who is borrowing the funds. Overall, the fees associated with margin trading on dYdX are relatively low compared to many centralized exchanges. However, it's important to understand the fees associated with each trade and to factor them into overall trading strategies. The borrowing fee on dYdX varies depending on the size and duration of the loan, as well as the specific asset being traded. Generally, borrowing fees are higher for assets that are more volatile or have lower liquidity. As an example, at the time of writing, the borrowing fee for ETH/USDC on dYdX is 0.08% per day. This means that if a user borrows $1,000 worth of ETH and holds that position for 10 days, they would be charged a borrowing fee of $8 per day, or a total of $80. It's important to note that borrowing fees on dYdX are subject to change based on market conditions and other factors, so users should check the current rates before initiating a